Governments around the world have been quietly stealing our purchasing power for years. The debasement trade is a strategy that many savvy investors have been using for years to protect their purchasing power from the devaluation, aka the debasement of the currency. Today, we're going to learn about that. Let's go. All of us have heard about inflation. Many of us are now starting to know about its negative effects, but very few understand how inflation actually hurts them. The basic analogy that I've seen many people give is that of supply and demand, which states the more abundant something is, the less valuable it becomes. And the more scarce something is, the more valuable it becomes. But this doesn't seem to be your case. The more governments inflate their currency, the more their currency becomes valuable to you to pay your bills and survive. Why is this? The reason is that a very small portion of that new inflated currency makes it to you in a timely, and that's important, timely manner. In reality, it's just a hidden tax that isn't collected, but is actually applied to everyone. And the proceeds from that hidden tax is then managed by non-government institutions who set the rules on who gets access to this newly created money first. And let me give y'all a little hint. It's not us. It's usually the rich. And all of that is done without your knowledge or your consent. Now, if the newly created money flowed directly to each individual in the same direct percentage to the percentage the central bank inflated the money supply, in my case, that would be this Federal Reserve, then inflation wouldn't matter. But that's not how it works, y'all. Instead, what happens is that money is disproportionately distributed to wealthy individuals first before it trickles down to you. So you will eventually see an increase in your money, but the supply and demand economics have already been skewed not in your favor, but in theirs. And since wealthy individuals receive the majority of that new money first, things become cheaper for them to purchase immediately, while the same things become more expensive for the average person to purchase long term. I'll be making a short video soon on how newly created Fed dollars enters the economy, so make sure you subscribe so you can check that out. Now, the debasement trade. To quote Robert Kiyosaki, it's basically saying, cash is trash. Governments are addicted to money printing and they will continue to inflate the money supply, therefore debasing the currency. By doing this, they increase the wealthy's purchasing power immediately while eroding your purchasing power before the money gets to you. Many people are waking up to this game. So instead, investors are choosing to hold limited amounts of cash, just enough cash necessary for short-term to mid-term needs. Longer-term cash and savings are now being deployed into what we call hard assets. This makes sense because many wealthy individuals and countries purchase certain hard assets continuously. So by storing your long-term savings in a hard asset, you are betting that governments are going to continue to inflate the money supply, which they have been, and you are essentially front-running the next inflation cycle. And the assets that the wealthy will continue to accumulate before they get the new cash, which remember goes to them first to buy these said assets. So let's define a hard asset. Hard assets are tangible, scarce resources that have intrinsic value and many times utility. They typically are durable and provide lower counterparty risk because you hold the asset or have almost immediate access to that asset, which is why they're often used as inflation hedges. Their worth doesn't rely primarily on financial promises from another party. Examples of hard assets are precious metals like gold and silver, energy resources like oil, natural gas, real estate, land, buildings, timber, and now some cryptocurrencies like Bitcoin and Ethereum are being considered a new class of hard asset. Now let's take, for example, the gold standard of hard assets, which is gold. Now I know a lot of people will say, no, it's Bitcoin. It's outperformed gold multiple times over. And yes, it has. But gold has been used for thousands of years, and Bitcoin is only approaching 2 decades. I think it's important to note that the debasement trade, the primary goal for many investors, isn't necessarily to increase purchasing power, but rather it is to preserve purchasing power. And gold does that beautifully, with much less volatility than Bitcoin. Now, if your goal is to maximize the increase of your purchasing power while holding a hard asset, and you have a higher than normal risk tolerance, Bitcoin may be for you. So let's look at gold. In 1971, and I'm picking 1971 because this is when Nixon took us off the gold standard, gold was trading for about $40 per troy ounce. Today, it's somewhere around $4,200 per troy ounce, which is about 100 times more in dollar term values. Now, we have to have a mindset shift where we don't care about the dollar value. I know it's going to be hard, but we don't care about dollar value. We care about the purchasing power. Let me give an example. In 1971, the average cost of a home was about $25,000, which means you could buy a home for around 625 ounces of gold. Today, the average price of a home is around $410,000, which valued in gold is about 98 ounces of gold to purchase a home. This means if you had enough money to buy a home outright in 1971, but held it in cash, today you would have just enough money for a down payment on a home. But if you converted that same cash in 1971 to gold, you would now be able to buy 6 homes instead of 1. So you would be able to have a main home, a vacation home, and a few rental properties if you decided. Let's take a look at silver. It hasn't performed as good as gold, but it still maintained its purchasing power over the years. In 1971, a house priced in silver would have cost you 14,000 ounces of silver. Today, a house priced in silver will only cost you around 8,200 ounces of silver. So you still would be able to buy a house and have money left over versus if you just held it in cash. So how do hard assets differ from stock investing? Hard assets derive their value from scarcity and or utility. More cannot be created, or at least easily created, and requires some type of work to produce more. And in some cases, like art, if the artist is dead, more can't be produced. Hard assets usually trade around the current price of the asset and tends to have a more illiquid marketplace, meaning at times it can be harder to sell even at market value. Stocks, on the other hand, derive their value from growth potential and earnings of the business. It's not unusual for a stock to trade at 20 times its current earnings. New shares can be created easily without work. Now, this could be a good or bad thing depending on the strategy of the business, but also stocks tend to have a liquid marketplace, meaning that you can usually sell them much easier and get that cash more instantaneously than with a hard asset. Stocks depend more highly on people and promises. That's why stocks usually have a higher counterparty risk, and hard assets depend on physics, utility, and property rights. Hard assets risk shift more towards storage, legality, and local markets or global market conditions. So, do I think people should take part in the debasement trade? This is not financial advice, and you should not take my word for it. I've lost plenty of money over the years in investments, so I am by no stretch of the imagination a guru. But my opinion is yes. I think it's pretty obvious that governments around the world will continue to expand the money supply, and one way you can protect yourself from the debasement of the currency is to proactively buy assets that will absorb that change in prices as it goes up. That doesn't mean you should just go out and buy any hard asset now. Timing can be crucial, and you want to make sure you understand the asset you are investing in and how it derives its value and how its market tends to trade. Currently, gold and silver are at all-time highs or near all-time highs, and everyone will tell you it's going higher. This could be true, but the best time to buy something isn't usually when everyone is screaming to buy that thing. Personally, I would pick 1 to 3 hard assets that you plan to study and begin to average in either on a routine basis, regardless of price, or maybe save cash on the side, wait for a sizable pullback, and then make strategic entries into your assets. About 2 decades ago, I heard someone say in a video that in the future there will only be 2 classes of people, the rich and the poor, and the middle class will erode. He said the rich will be everyone who learns to invest, and the poor will be everyone who only works and doesn't look for opportunities or new opportunities to invest in. The Bible sums this up in the parable of the talents in Matthew 25, verse 14 through 30. Today, all people can invest, and we can preserve the middle class by creating the hybrid worker investor. We also need to demolish the gatekeepers who have been working behind the scenes to keep the poor and the middle class from having access to certain investment opportunities. I will do videos on this topic in the future as well. If I've brought any type of value, please do one or all of these things. Like, drop a comment, subscribe, or share. It lets YouTube know that my channel has valuable information, and therefore YouTube will recommend my video to a larger audience. Have a blessed day. See you in the next one.